You've been told the $5 treat is harmless, small kindness, a bit of self-care, the one thing left, the one you can still afford. Yet the company behind the most famous one just filed its annual results, and the gross margin reads 72.1%. Higher than Hermès, higher than the house that makes the Birkin bag. 92% of Gen Z treat themselves, 20% do it daily, and 1 in 4 run $2,600 a year through it. This isn't impulse spending. It's the consolation economy. And it is not coming for your budget. It is coming for the thing your budget was for. To understand why a plastic monster costs $85, look first at what stopped being buyable. In the United States, the median age of a first-time homebuyer is now 40 years old, an all-time record per the National Association of Realtors on transactions from July 2024 through June 2025. 4 years earlier, that number was 33. 7 years added to the wait, in 4 calendar years. First-time buyers are now 21% of the market, also a record in the other direction, and in 2007, just before the Great Recession, that share was 50%. So the entry ticket to the largest asset most families ever hold, the house, has gone from half the market to a fifth of it in under 2 decades. Picture a staircase, and somebody keeps removing the bottom step. You're not climbing slower. The step is not there. That is the condition. Here is what people do inside it. 53% of Gen Z say, directly in survey responses, that they buy small treats because the bigger milestones, the vacation, the house, feel unaffordable, not as a metaphor, as a substitution. A majority of a generation describing a trade they already made. 62% call little treats essential to their self-care, and they are not being dramatic. The relief is real, it is measurable, it just does not survive the afternoon, which is the structural oddity underneath all of this. When the large purchase goes unreachable, the small purchase stops behaving like a small purchase. It becomes the stand-in, inheriting all of the emotional weight and none of the value. That is the milestone gap. And it is the raw material, the seam. Every company in this story is mining. But how does a $5 habit become a $2,600 a year without anybody noticing? Easy. It is priced not to be noticed. Ask 1,000 Gen Z adults where a treat stops feeling reasonable and the average lands at $40. Under 40, fine. Over 40, irresponsible. Now ask 1,000 Americans what they would pay for one small vinyl monster clipped to a backpack. $85. And 1 in 5 will go to $100. The stated ceiling is $40. The revealed price is $85. And nobody in either survey believes they did anything unusual. That distance between the number people say and the number people pay is the audit threshold, the price beneath which a purchase is not counted at all as spending. And the industry knows exactly where it sits. Here's the arithmetic nobody runs. 92% of Gen Z treat themselves, 52% weekly, 20% every single day, and roughly 1 in 4 keep a treat budget, $50 a week or more, $2,600 a year. At the median treat price of $5, that is 520 separate decisions in a year, 10 a week, 1.5 a day, each one small enough to vanish, none of them ever landing on the same line of the same statement. A budget catches a boulder. It has never once caught sand. And the spread inside that number is the part worth seeing. The median American treat costs about $5. The most expensive one about $10, which works out to roughly $30 a month, $360 a year, and nobody sensible would call that a problem. The Gen Z quartile, running $50 a week, is spending more than 7 times that. Same habit, same $5 unit, same feeling of harmlessness at the till, and a gap, $2,240 a year, between the two, none of which ever announces itself, because the individual purchase never changed size. 36% of Gen Z admit it outright. They struggle with self-control around small indulgences, which is a remarkable thing for a third of a generation to volunteer on a survey. They are not confused about what is happening. They can see it, name it, and still not catch it, because the threshold is doing the hiding, not them. And these buyers are not careless. 63% of Gen Z call paying full price financially irresponsible, and 64% will drop a favorite brand purely for a discount. This is a generation that negotiates ferociously above the threshold and never, not once, looks below it. That is not a failure of discipline. That is discipline, aimed at the wrong altitude. Which raises the only question that matters here. Who found the threshold first? Mart. In 2024, Mart was a successful Chinese toy company, turning over 13.04 billion yuan. In 2025, it booked 37.12 billion, about $5.4 billion, up 184.7% in 12 months. Anchor that properly. Mattel, Barbie, Hot Wheels, Fisher-Price, a company nearly 80 years old, did $5.35 billion in the very same year. Same size. One of them grew 184%, while the other shrank by 1. One character line does most of the lifting. The monsters, Labubu's family, brought in 14.16 billion yuan alone, up 365.7%, roughly 38% of everything the company sold. And set that against the year before. And one cartoon character, in 12 months, out-earned the entire company's total revenue from the previous year. And the trajectory is the tell. In 2024, the monsters had already done 3.04 billion yuan, up 726.6%, already enough to displace Molly, the company's biggest character until then. 2 years, 2 consecutive triple-digit years, on one line of intellectual property. Net profit up 293.3%, gross margin 72.1%, climbing from 66.8%. That margin is the whole story. So anchor it too. Hermès, Birkin bags, silk scarves, waiting lists measured in years, ran 71.1% in 2025, and Apple, in the best year of its history, ran 46.9%. A plastic figure in a cardboard box carries a fatter margin than a Birkin. Now the fairness concession, because it matters, nobody at Mart set out to hurt anyone. There is no executive twirling a mustache in a boardroom, and they were doing what every toy company was trying to do, survive a category that had stopped growing. Mattel's flat year is the evidence it had. The difference is that Mart stopped selling toys and started selling the scarcity engine. Limited runs, timed drops, sealed boxes, a secret edition you're not allowed to choose. It worked. At a scale that is hard to hold in your head. 630 stores, 2,637 vending machines across 20 countries, and revenue from the Americas up 748.4% in 1 year. Not 74, 748. That is not a toy company having a good year. That is an extraction system, finding a new continent. But the pricing was only the delivery mechanism. The actual machine is inside the box. A blind box is a product you buy blind, without knowing which version you get. And that single packaging decision, that one choice, is the most valuable asset in the industry. It is not a gimmick. It has a name in the research literature: variable ratio reinforcement, a reward delivered on an unpredictable schedule. And it is the same reinforcement structure, the one sitting under a slot machine. A vending machine that always trains you quickly to stop thinking about it. A vending machine that sometimes trains you to keep pulling. In April 2025, BMC Psychology published a study of 434 blind box consumers modeling exactly this, and the findings are worth stating plainly. Perceived uncertainty drove 2 things at once: instant gratification and the gambler's fallacy, the belief that a run of losses somehow makes the next pull more likely to pay. Both then drove irrational consumption, and perceived scarcity made it sharper still. The more limited an item felt, the more strongly that fallacy converted into buying. So, the levers are not independent. They compound. Uncertainty creates the itch, scarcity sharpens the itch, and the fallacy insists the next box is due. Call it manufactured uncertainty, because none of it belongs to the toy. A vinyl figure contains no randomness at all. The randomness is added deliberately at the packaging stage, and it is the single most profitable component, by far, in the finished product. You're not paying $85 for a monster. You're paying for the not knowing. And the box does not have to find you on its own. 62% of Gen Z have bought a little treat because an influencer highlighted it, and nearly 3 in 5 go to TikTok specifically for treat inspiration. So, The scarcity signal is not sitting on a shelf, waiting to be noticed. It is delivered algorithmically to the people most likely to act on it. At the moment, they are already looking. And the market answers exactly as designed. Nearly 3 in 5 Americans report pressure, real pressure, to buy the hot item of the year, and among Gen Z, 71%. 47% have paid above retail for a limited or viral item. 1 in 10 paid 75% or more above it. And 14% of collectors, more than 1 in 10, have gone over $1,000 into debt for viral collectibles. $1,000 of debt for an object whose scarcity was a decision made by somebody in a meeting. At this point, the defense writes itself, and it is a strong defense, strong enough that most coverage stops here and calls the whole thing harmless. The official explanation runs like this. Small treats are rational. When the big purchases go out of reach, people redirect towards small luxuries and take genuine satisfaction from them. This is not folk wisdom either. It is a documented economic effect with a name, the lipstick effect, and a 2020 study, Journal of Behavioral and Experimental Economics, found exactly that pattern under hard conditions. And it sounds reasonable, convincing even. Trading a vacation you cannot afford for a $5 coffee you can is not irrational behavior. It is arithmetic, performed on the options actually available, and anybody lecturing a 25-year-old about coffee, while the first home age climbs to 40, has the causation running backwards, and the defense has real numbers behind it, which is why it deserves a proper hearing. 66% of collectors report genuine excitement when they buy something trending, and 44% say they would buy anyway. No resale value, no viral moment attached. That is not a market of addicts being fleeced. That is a large majority reporting that they like the thing and would still like it if nobody else were watching. But the lipstick effect describes a substitution. It does not describe a ratchet. And the data out of this market does not look like substitution, satisfied or otherwise. 42% of collectors regret buying on hyper impulse, and among Gen Z, 52%. 59% of Gen Z who buy a weekly treat say the habit leads them reliably to overspend. 41% report financial guilt at least once a week, weekly, not occasionally, and 40% go looking for validation from a friend, from family, before or after they buy. That is not what satisfaction looks like. Satisfaction does not need a second opinion, and it does not arrive on a guilt schedule. So name it accurately. The lipstick effect is real, and it is being used as cover. It describes a person choosing a small pleasure and says nothing at all about an industry engineering randomness into that pleasure, deliberately, to lift the repeat rate and the engineering. That is the part that turns a substitution into a habit, which points at the real motive. And Mart's own filings state it plainly. The plush category grew 560.6% in a year to 18.71 billion yuan, the soft toy line alone, now larger than the entire company was 2 years earlier, and the biggest category it has. The product did not get better. The randomness got better distributed. The treat is the delivery vehicle. The uncertainty is the product. So where does the money actually end up? Not in the toy, in the gap it was standing in for. Here's the whole system, running as one cycle in 6 steps. Step 1, the milestone goes out of reach. First home age 40. First time buyer share 21%. Step 2, you substitute something you can still control, and it works, genuinely, briefly. Step 3, unmet wanting does not stay where you left it. A 2020 study, Journal of Consumer Research, found that unsatisfied curiosity converts into something else, a generalized appetite for reward, and people start reaching for small, unrelated pleasures. The desire detaches from the thing you wanted, and it goes shopping. Step 4, frequency climbs, and the threshold drifts up with it. 40 was the stated line, 85 the revealed one. 28% of Gen Z treat themselves to handle stress, 21% as a reward for finishing something, and eventually, the trigger stops needing to be an occasion at all. Step 5, the money leaves the one account, the exact account that would have closed the gap, $2,600 a year, in $5 and $10 pieces. Step 6, the gap widens. Return to step 1. That is the Consolation Loop, and its defining property is simple. Every single step inside it is reasonable. No bad decision, anywhere in the chain, no moment, anywhere, where a sensible person would intervene, which is precisely why almost nobody does. It is a treadmill that bills you for the walking, and it leaves a second debt, one that never appears on a statement. 67% of Gen Z say they spend more on goods than on experiences, and 19% say small treats are their main source of joy during the week. Not a source, the main one. Read that twice, because it is not a spending statistic. It is a status report on everything else in the week. Meanwhile, 42% of Gen Z are living paycheck to paycheck while all of it runs. Call that second one the regulation debt. Every time discomfort arrives and a purchase resolves it, the purchase gets fractionally more automatic, the tolerance gets fractionally thinner, several times a week, for years. What erodes is not the bank balance. It is the capacity to sit inside a boring Tuesday without buying your way out of it. And that capacity, it turns out, is the thing every slow, unglamorous, compounding project runs on. A balance rebuilds in a quarter. That other thing takes considerably longer. And the loop is not stable for the people running it either. When Mart posted those results, its shares fell more than 22%. Investors reading the same numbers and seeing one thing: a company whose growth rests on one character staying fashionable. So here's where all of it lands. The milestone recedes to 40. The substitute arrives priced beneath the line where anybody checks. The randomness is engineered into the box. The scarcity sharpens it. The fallacy insists the next one is due. And a mid-sized toy company from only 2 years ago now runs a fatter margin than Hermès, while the money that would have closed the gap leaves quietly in $5 and $10 pieces, 520 times a year, out of an account belonging to somebody already living paycheck to paycheck, and already feeling guilty about it weekly. The little treat was never harmless, and it was never a moral failure either. It is the one purchase left, the one a generation priced out of everything else can still make. And a 72% margin was built on that fact, not on the toy. This is not financial advice, and please do your own due diligence. Which leaves a question worth sitting with. If the small purchase is the only one still available, is buying it a failure of discipline or the last rational move on the board? Because whichever answer you land on decides the rest of it. Whether this is a problem to fix inside yourself or a price to renegotiate with somebody else. And the consolation economy is only the retail end of it. The same milestone gap is being monetized in much larger rooms, by lenders, by landlords, by an entire industry, quietly repricing itself around one assumption: that you will never own the big thing at all. So subscribe and catch the next one. Why you'll rent everything you own. Or watch this.